Hello, everyone. Thank you for joining us. I apologize. It takes me a while to get everything reestablished after the lovely video that our production team puts together. Thank you for being here today. We're going to be talking about year-end tax planning for individuals here at the end of 2024. Delighted to have four of my partners here with us today. Marcy Spivey will kick it off. She is a partner in working out of our Atlanta practice. She is the leader for our private client services team. We also have Carol Marin. She works out of our Austin practice, and Jeff Horsley out of Atlanta. Both Carol and Jeff are both partners and work with our private client services team. Mike Kirkman is the leader of our estate gift and trust services team, and he works out of somewhere in North Carolina. He's usually on the road, Charlotte maybe, Raleigh maybe, somewhere in between. But we'll let him tell you where he's located at the moment. Anyway, delighted to get things going. So let us turn to our agenda. And Marcy, why don't you tell us what we're going to cover today?
Thank you, Sarah. Of course, yes. So today we're going to talk about year-end planning, things that are new for 2024. We'll talk about potential tax laws changing, estate gift and trust, and some other considerations that go along with any kind of planning that we can do at year-end. So who should plan? Who should do year-end planning? Not everyone. If your income and deductions and everything stays the same year over year, and you really don't have any opportunity to trigger additional income or deductions, then you probably are keeping your withholding the same and you're moving from year to year pretty seamlessly. People that do need to plan are those that have experienced a life event, like they've moved, they've had a child, they got married or divorced. Other people that should plan are those that have moving parts to their income. So potentially they had losses last year and this year they're going to have gains. Or if they have changed jobs and maybe their bonus changes from year to year. So anytime your income and tax payments are changing year to year, or if you have the opportunity to change them. So people who are doing charitable planning are often wanting to look at their income and see how much they should be giving in this year compared to next. Also, people who, like I mentioned, have year-end bonuses may need to look at their total income compared to their withholding. Those that have opportunities to trigger income, such as do a Roth conversion, would also want to be looking at year-end. And then those that maybe want to sell securities to either accelerate a gain or a loss, it can also be looking at year-end. And then payment planning is also an important part of this. A lot of us make estimated payments based on last year's tax, and that's okay to do. And a lot of times it is the right thing to do. And that can carry us all the way through the January payment. However, some of us did not make payments based on last year and instead want to make payments based on 2024's income. And so as we look at payment planning, we need to decide whether to pay based on 2023 or to base our tax payments on 2024. And this is not only for our January payment. Also, some of us may want to get a glimpse into how much we're going to owe in April. And year end is a really good time to do that. And that way you can get your cash flow in order for the April payment, which will be the balance due on all of 2024 tax, regardless of what prior year tax was. So I think that's it for the introduction, and I'll kick it back to Sarah for the polling question.
All right, we're at our first polling question. So if you'll take a look at that. So which taxpayers should engage in year-end tax planning? I think Marcy just gave us a very good idea. Those who are owners of closely held businesses, taxpayers with life changes during the year, taxpayers who make charitable contributions, or all of the above. So what are your thoughts about who really should engage in year-end planning? We'll give you just another few moments. I think somebody asked the question about where the polling questions would appear. This is what they look like, and there will be 4 of them during the presentation, spread out during the presentation. All right, we'll give you just another a couple of 10, 15 seconds to put an entry in, a note in. We want to make sure those of you that need to get CPE credit can get that credit. All right, we want to go ahead and close that poll and let's share the results. See what everybody thinks. Great. A lot of you are saying all of the above. Excellent. Well done. We will now move on to our next section. And Carol, I think you are up to talk about what's new in 2024.
Thanks, Sarah. Yes, there's, as with any tax year, there's adjustments made each year. So I'm going to talk about some of the items that are different for 2024 or adjusted amounts. As you can see here on the slide, there's a standard deduction, obviously increases each year. So the married filing jointly jumps up to $29,200. Unmarried comes in at about $14,600. Head of households, $21,900. And then, of course, there's the additional deductions for those who are 65 or older or blind. The child tax credit is still around for 2024. It's about $2,000, or it's at $2,000 if you have a child who's 17 at the end of 2024. Only the refundable portion is $1,700. Of course, the child tax credit does phase out depending on the income range, and it's at $400,000 for married filing jointly and $200,000 for all other taxpayers. And then there's one other non-refundable credit for other dependents, and that's $500. So as with the numbers I just went through, we have some inflation adjustments to the major items of the tax world. They can be found in these different revenue procs that come out at the end of each year, just to adjust so you know. So for 24, for instance, the bracket, the 37% tax bracket came in at married filing jointly at $731,200, and now that has gone up to $751,600 for 2025. So in 24 for unmarried, it's at $609,350, and it jumps up a little in 25 to $626,350. The all-important long-term capital gain tax bracket at the 20% in 24 is going to be at $583,750, and it's going to jump up to around $650 for 25 for that married filing jointly. And then the 461L loss, which is for the limit on the excess business loss, for 24 is capped at 610. For married and unmarried is 305. And then for 25, we're going to jump it up to 626 and 313 respectively. 401k contribution for 24 is at $23,000, and it's going to jump up to $23,500 and $25,000. Now the catch up for those over that are eligible for the catch up are at $7,500. That did not change from 24 to 25. The IRA contribution for 24 and in 25 are $7,000, and the catch up is at $1,000. And then lastly on the slide, the defined contribution plan limit for 24 is at $69,000, and it's going to jump up to $70,000 in 25. There's definitely different residential energy credits that are around, and they can get kind of complicated. So we wanted to bring up some of the highlights that are here. So the first one we're going to talk about is the residential clean energy credit. Now, this is for an investment in renewable energy type property for your main home. So the proposed regs right now say the main home is where you live most of the time. So they're trying to put some regs out to clarify that position. And this credit that I'm going to discuss can apply to new construction. So what is renewable energy property? And that's going to be like solar, wind, geothermal, solar water heaters, fuel cells, battery storage pack technology are examples that qualify. So that credit is 30% of the cost of the new qualified energy property, and it's got to be placed in service before 2032. There's no annual limit or a lifetime maximum, but there's very detailed requirements that have to be met. So we've listed a website there, www.energy.gov, that you can, as sort of a reference to go through and see. And of course, if you receive any sort of subsidy or an incentive or rebate from the manufacturer or for the person installing it, you need to reduce the credit by that or reduce the cost by that. Okay, next is the energy efficient home improvement credit. Now this has to be in improvements to your main home made in 23 and no later than 2032. The main home, this cannot include new construction since it's an improvement credit. It's 30% of the cost of qualified energy efficient improvements installed during the year, and residential energy property expenses and home energy audits. There's no AGI limit and no lifetime limit, but the annual credit is limited to $3,200 for all of your qualifying improvements. So some example of improvements include doors, exterior doors, windows, skylights, biomass stoves and boilers, some water heaters, various items there. There's a $1,200 annual credit on different types of improvements. For windows and skylights is $600. Exterior doors can be $250 each, but you max out at $500. And then the home energy audit's $150. There's a $2,000 annual limit for qualified heat pumps and stoves and biomass boilers. And like I said before, this credit is available for existing homes and renovations and additions to the existing home. This credit is not refundable, is non-refundable, and does not carry forward. So now there's the Form 1099-K. So this has been around for a few years, but there's a new threshold this year, and it's for $5,000 is for the transactions for a particular service. So who issues a 1099-K? So that's going to be the payment card processors and third-party network transaction companies. And some examples of where this area comes into play is Venmo, PayPal, Etsy. There is on the 2024 draft 1040, there's a new question that at least is proposed on the draft that you have to answer if you've received a 1099-K for any income, for any amounts that are not income to you. So just look for that new question coming in. Virtual currency and non-fungible tokens. There's always new information surrounding this area. So on the 1040, there's going to be two questions regarding digital transactions. It's going to ask, did you receive a digital asset during the year, or did you sell or exchange or dispose of a digital asset? So those questions are directly on the return. Important for this year, there's a revenue procedure 2024-28. What that is addressing is sort of relief around how basis is allocated among all your digital assets. That by January 1st, 2025, you're no longer allowed to treat your wallets as one different wallets as one. So there's a relief in there on how you can go and allocate your basis into these areas, into your different assets. The reason that this is really important is that beginning in 2026, custodial brokers are going to be required to report on a new form 1099-DA, which is going to make you, or it's going to have them report gross proceeds. And then the following year, they're going to need to start reporting basis. So that's important that all of the basis gets allocated to the proper place, and just kind of tightening up on that. And with any tax information, it's extra important that you collect all your information on your digital assets for their tax return as soon as possible. Okay, so the TCJA tax provisions that are going to be expiring at the end of next year at 12/31/25. Just as a reminder, some things that are coming back. The tax rate, the highest tax rate, is going to be coming back in at 39.6%. The itemized deductions return, the SALT limit goes away, mortgage interest applies to the first million, miscellaneous itemized deductions return, standard deductions correlating will go back to the pre-2018 levels. The child tax credit is set to be reduced. Just for all different reasons, alternative minimum tax may affect more taxpayers going forward. The estate tax lifetime exclusion is reduced. And then the Section 199A QBI deduction is eliminated. So it's important to keep all of these in mind when you're planning for 24, 25, and 26, since it's sort of in flux, and just to keep your attention and your planning flexible. All right, so that takes care of my part. I'm going to turn it over to Jeff, who's going to discuss managing income and expense.
Thanks, Carol.
Right. I think, Jeff, we're going to start off with a polling question for your section.
Yep.
Just to see how much people know about IRAs already. So
Yep.
taxpayer reached age 72 in 2024. Must she take an RMD, a required minimum distribution from her IRA before December 31? Yes, no. No, she doesn't have to take one, but penalties may be due for a late distribution, or not sure. So give us your best shot at this one. A taxpayer age 72 in 2024. Is a required minimum distribution necessary before the end of the year? And Jeff, I know you have the answer to this super amazing question.
Yep. We'll get to it in just a sec.
Yeah, let everybody vote on that. And so one of the things, Carol just went through all of the list of a number of the provisions that under the Tax Cuts and Jobs Act are planned to expire at the end of 2025. But with new administration and a lot of talk about taxes, we don't know if Congress is going to extend those, make some changes to them, extend some, but not others. We'll just have to really wait and see in the future. But I think we're using this time to really talk about what we know the law is currently. All right, that was polling question number 2. I see some of you say yes, no, but not sure. Those are some great answers. Let's let Jeff tell us what the answer really is.
Right. So the answer is no. The age this year, starting in 2024, is 73. It used to be 72, and it was 70 and a half before that. But excuse me, now it's 73. So if you turn age 73 in 2024, you're generally going to have to take your first required minimum distribution RMD by April 1st, 2025. But if you do that, if you defer your first distribution, if you don't take it this year and you take it early next year, then you wind up having to take 2 distributions in 2025. And that could have the effect of sort of bunching income into 1 year and could push you into a higher tax bracket, cause more overall tax hit. So in some cases, you may be better off taking some or all of that first distribution this year to sort of spread it out. Okay, so one of the big things that we saw this year in this space was the Treasury Department issued final regulations in July this year that address RMDs from inherited IRAs and qualified plans. These regs, they're effective January 1st, 2025. And one of the big issues that these regs address is the 10-year rule that came out of the Secure Act several years ago, where for certain inherited accounts by non-spouse beneficiaries, you have to take the entire account balance distributed within 10 years of the death of the account owner. So there were questions around, can you take it all in year 10? Do you have to take certain amounts sort of spread over time? Well, the answer is, according to these regs, you have to take a certain minimum amount every year along the way. So for taxpayers for a death between 2020 and 2024, certain non-spouse beneficiaries have to start MDs from these accounts in 2025. And the distributions are based on calculations based on the age of the beneficiary, or in some cases, the account owner, and applying the actuarial tables for the single life expectancy that are published by the IRS. And you have to conclude that by the 10th year. So it still has to be flushed out completely by year 10. But depending on the age of the beneficiary, the account owner, you could conceivably have fairly small amounts over the first 9 years, and then a big catch-up distribution in year 10. So for larger accounts, certainly there may be some planning opportunities to try to smooth that out in some cases, minimize tax over that entire period. And that's, we can help you guys with that for planning and projections if you want. Roth accounts still have no RMD requirements during the owner's life. Only after the owner dies, then the beneficiary inherits the account, they have to start taking RMDs. And these address a lot of other areas in this space. These things are really extensive and complicated. I would definitely get professional advice before trying to interpret these and apply them to your situation, just to be safe. And by the way, what's the penalty if you don't take an RMD on time? Under current law, it's 25%. There's a 25% excise tax that they hit you with. So, can be fairly significant. So you want to try to stay on time with these. Surviving spouses have more flexibility. After the Secure Act 2.0 came out a couple of years ago, they have the ability, a surviving spouse can roll the deceased spouse IRA into their own IRA account and apply those rules, or they now have the option of deferring distributions from that inherited account until the deceased spouse would have had to start taking distributions from that if that hasn't occurred yet. And there's some other options in there too. So surviving spouses have a good bit of flexibility. Next slide. Okay. All right, let's talk about tax planning with IRAs. Really not any big changes this year on this front. There's still no age limit for contributions to traditional IRAs or Roth IRAs for that matter. But there are income limits. There's income phase outs. If the taxpayer spouse is a participant in an employer retirement plan, then you may not be able to deduct your contributions to an IRA if you exceed certain income limits. And you have to have earned income to fund an IRA, right? So, what are we talking about? We're talking about W-2 income, employment, some kind of employment income that's subject to either FICA taxes or self-employment tax generally that's earned in order to be able to fund IRAs. Consider maxing out your retirement contributions to IRAs, whatever retirement accounts you have each year. Besides the deduction benefit, the tax-free compounded growth potential in these accounts especially over a long period of time, 10, 20, 30 years or so can really be huge, so don't miss those opportunities where you have them. Qualified charitable distributions. This has been around for a while. It was $100,000, just a fixed amount for a while, and now it's indexed for inflation. And 2024, the amount is $105,000 per person that you can transfer directly from your IRA to a charity, qualified charity, and it's just for people over or age 70 and a half or over. $108,000 is the limit for 2025. And these also count towards your RMD requirement. So that's really the context in which we tend to see these more. Whatever you take that's transferred to charity is that much less that you have to take out personally, and can be more tax efficient than taking distributions and then funding charity and taking Schedule A deduction. Roth conversions, Marcy touched on this. If you're in a low income year, or you got losses this year, it might be something to look at to do a Roth conversion from traditional IRA or qualified plan amounts. You got to pay the tax on the conversion. So in low income years, the tax hit is generally going to be not too bad. And you generally only want to do this if you can pay the tax from outside dollars, so that you don't erode the amount that's flowing from the old account into the new account. You want to keep the maximum amount in there growing, tax-free compounded. Next slide, please. Okay, health savings accounts, really not much change here. The limits are up a little bit for inflation indexing, $4,150 you can fund for self only, $8,300 for family coverage. You have to be a participant in a high deductible health insurance plan. You can fund these as late as April 15th, 2025 for this year and deduct for 2024. Tax-free earnings while inside the HSA. So, some people use these kind of like a supplemental retirement account where you don't necessarily take distributions, reimbursements for medical expenses each year, but you let the account continue to grow. And then you can take distributions in a later year, but you have to save your receipts in order for those distributions to be qualified. And if you don't do that, if you have non-qualified distributions from these, they're just taxed as ordinary. And if you're not age 65 or disabled, then there's another 20% penalty excise tax on that. So you want to try to avoid that. All right, plenty of good stuff on the gain deferral front that's still out there. Opportunity zone funds, they've been out there for several years. They're still in play. The idea here is you invest in a qualified opportunity fund within 180 days of after a gain event. that 180-day period, the starting point depends on if it's a direct sale, it's just the direct sale date generally. But if it's flowing through a K1, say a partnership or S corp K1 that's got gains to you, then that 180-day period doesn't really start until the due date of those returns, which would be March 15th, 2025 for 2024 K1s, a calendar year. And then you would have it until it's as late as September really to invest in one of these and make the election to defer gains. So you can only defer gains until December of 2026 now. So it's only a couple of years you get. But the bigger upside on these really is if you hold your investment in the Qualified Opportunity Fund for at least 10 years, then you can exclude the gain from the liquidation of that investment on the back end. So, potentially big, but it's first and foremost an investment play. The investment doesn't perform well, or it loses money, then the tax benefits don't really mean much, right? So consult your financial advisory team before doing these for sure. Installment sales are still around, no big changes there. The idea is you sell an asset, maybe you get some money this year, you taxed on that portion of it, but you take an installment note or some payment deferral mechanism pushes some of the payments back into later tax years. And in many cases, you don't have to recognize gain until you receive those payments. So it's a good way to defer gain. For larger sales, though, if the note amount from the gain deferral is more than $5 million, there's a cost to it in the form of an interest charge that the government charges under Code Section 453 Cap A. And it's tied to the interest rate that's published for the fourth quarter for underpayments each year. Right now, that's 8%. So, that's can be pretty costly, and that's non-deductible. It's sort of assessed like a tax. It's non-deductible for individuals and trusts, so it can be kind of costly to do these in a high interest rate environment. But still something to look at in some cases. 1031 exchanges are still around, available only on real estate though, and it has to be either investment, rental, or trade or business real estate. It can't be personal use property, like a beach home or something that you use personally. But still a good way to, if you want to keep chips on the real estate table, to defer gains for potentially a long period of time. Code Section 1202, qualified small business stock. This is a great one where it fits, where you can jump through the hoops to get it to be effective, because the gain, this is exclusion as well. We're not talking about deferral here. We're talking about excluding gain from the sale of qualifying stock. Up to $10 million of gain exclusion, or 10 times your adjusted basis in the stock, you can exclude. But it's got to be C Corp stock. The stock has to be issued directly to you as the shareholder, or in some cases you can get it via gift, but there's only certain ways you can get it. It has to be when the company is relatively small. There's a $50 million valuation rule. A bunch of other requirements you got to hold it for 5 years. It can't be certain service type businesses. Code Section 1202E3 defines these businesses. It's, generally think of doctors, lawyers, accountants, financial advisors, artists, athletes, and certain other professions. This won't work for. But with some good planning, this can be really, really effective. And in some cases, there may be opportunities to establish multiple buckets of gain exclusion with gifting and trust sometimes if you plan ahead. So if you think you might have this opportunity with an investment, let us know and we can help you plan for that. Loss harvesting still around. The idea is you have some capital gains, you sell maybe some stock or something to generate a loss to offset that gain. You just have to watch out for the wash sale rule, the 30-day wash sale rule, where you can't repurchase it within 30 days or the loss gets deferred. Casualty losses and gains. All right, this is pretty timely, given all the hurricanes and natural disasters it seems we've had here lately. Casualty losses, they really fall into two different buckets. So there's business casualty losses. There's non-business property casualty losses, I think, for individuals, and those are the ones we're going to talk about today. So these are limited to losses that are incurred in a federally declared disaster. For example, Hurricane Helene or Milton, one of the recent storms that hit. So the deduction that you're eligible to take is the loss of value that's sustained from this event. And there's various ways to determine that, but the loss is also limited to your tax basis in the property. And it must be a result of the disaster. So whatever the hurricane, the flooding, or whatever it was must have caused the damage. You can elect to take the loss to deduct the loss in the year of the loss, or you can elect to take it in the prior year. So you got flexibility there. You can also have a casualty gain. I think the most common example I can think of is, say your house gets destroyed by a fire or flooding or something like that, and you get insurance proceeds for it. But let's say you've owned your house for a long time, your tax basis is really low. You can have sort of a deemed sale effect that creates taxable gain from that event. But as long as you generally replace that property within 2 years of the loss year end, or in some cases 3 years on certain types of real estate, you can defer that gain that would otherwise be taxable to you. Deducting business losses, really no big changes here. Same rules, same limitations, like on K1 losses flowing through from S corps and partnerships. You got to have stock basis or debt basis to deduct it. You got to be at risk in it, as those rules are defined. Passive loss limitations can come into play if it's a passive activity. You can only offset losses, those kinds of losses, against passive income, or if the entire activity is disposed. Generally, you may be able to take it. The excess business loss limitation, Carol mentioned this earlier. It's you're limited $610,000 of net business loss that you can take in 2024 against other income. For single filers and others, is $305,000. So what that means is, if you have a loss, combined business losses in excess year, the excess amount just carries forward into the subsequent year, and it converts to a net operating loss. Net operating losses are subject to different rules. They roll forward. You can't carry those back anymore. Used to could, but now they roll forward, and they're limited to 80% of your current year taxable income. So you can't use net operating losses to completely zero out your tax, but you can put a big dent in it. And they roll forward until eventually used up, indefinitely. Let's go next slide, please. All right, 199A. This is the 20% pass-through qualified business income deduction that's been out there for many years. It's only on certain trader business income that you can take this deduction, but let's say you're in the 37% top marginal rate bracket. If you're able to generate a 20% deduction on some of this income that's flowing in as ordinary, your effective tax rate on that is 29.6%. So, large amounts of income can have a pretty big effect. There are income phase outs for this deduction that start between $383,900 and $483,900 this year, or half of those amounts. That's for joint filers. It's half of those amounts for other filers. So what that means is, up to those limits, there aren't many limitations. There are some, but not many limitations for taking this deduction. Once you get over that threshold, then there's additional hurdles that you have to clear. So the deduction is 20%, but then it's limited to 50% of wages allocable to that business activity, or 25% of wages and 2.5% of unadjusted basis, and some other rules and limitations come in play. Also, once you get over that threshold, specified service trades or businesses, which are the same ones that we just talked about for qualified small business stock, 1202E3, you can't take QBI deduction against that kind of income. So, again, doctors, lawyers, accountants, service providers are generally that group. So this is looked at and calculated on an activity by activity basis. So in some cases, there may be the ability to make aggregation elections to group activities and might free up some more deduction. I mean, those rules are really complicated and limited, but we can certainly look at it if you think you might have an opportunity there. There's a rental real estate safe harbor. Some real estate you can't take this deduction on, for example, triple net leases, but certain rental activities might fall into the trader business category. And there's a safe harbor rule. If you spend 250 hours of activity in a real estate activity, you might be able to take the deduction against that. But you got to have contemporaneous documentation showing your activity to prove that. And you also generally want to file 1099 MISCs for any trade or business, even if it's real estate, because that requirement exists for any trade or business activity. So, there's penalties if you don't file those, but it also might help support your position that it's a trade or business if you do those required filings. Okay, next slide. All right, so let's turn it over to Mike Kirkman, or we're going to do a polling question, I guess, right, Sarah?
That's right. We're at our next polling question. And so this one is, how much is the annual gift exclusion for 2024? Is it $15,000 per donee? Is it $18,000 per donee? Or is it $35,000 total for all donees? Are not sure. Where do you think the annual gift exclusion is for 2024? And then we'll let Mike come on screen and online and give us the answer to that question in just a moment. All right. Yep, we'll give you just another moment or two to do this. And so, Jeff, I'm sure you do a lot of analysis on that QBI deduction. It's a pretty big one for people to be able to take and cut their tax rate from about, say, 37% down to about 29 or so.
Yeah, for sure. I mean, we see in some case, hundreds of thousands of dollars in some cases, depending on type of income and how much deduction and those limitations we're talking about. So it's a big one for sure in many cases.
Great. All right, Mike, tell us the answer to the question. Is it 15,000, 18,000, 35,000 total, or not sure? What do you say the answer is to this question?
The answer is 18 per donor per donee. And I'm sure a lot of the not sures might have been folks in the EGT group that really likes to have specific fact patterns ahead. So if you answered not sure because maybe you were thinking you could, husband and wife could transfer 18 to each child, which it would be a 36,000 gift. So anyway, it is 18 for 2024. These are some inflation amounts that have kicked in going into 2025, the final year pre-sunset. I'm not sure why they didn't round up the lifetime exclusion to a smooth 14 million. When I started practicing, the exemption amount was 600,000. So that dates me severely. And I did 706s way back in the mid 80s. And I'm sure hopefully some folks on this call remembers the $600,000 exclusion. We have never been as high as we've been as a result of the 2017 Trump tax law that are going to expire in 2026. So you can read what's cooking here. The one that really always jumps out that gets missed a lot is this last one, the fiduciary rate. And we're going to talk about that a little bit later. But just notice that the top, if you can remember in an earlier slide that Carol was illustrating, is that the top bracket for individuals is way up there in the 700K for a married filing joint. The top bracket for fiduciary, that's trust and estate income tax, is a mere 15,200 this year. So next slide. So most of you, if you haven't heard me beating the drum, and not the snare drum, it's more of a bass drum because it's loud and low, about what's going to happen in 2025 sunset, Gus Perez and the valuation group have been going gangbusters on trying to get high net worth individuals to utilize their high exclusion of 13 million, 26 million per husband and wife before the sunset, which everybody was anticipating to drop somewhere between 7.5 and 7.8 million. Now that the Trump administration looks to have won the House and definitely the Senate, that everybody's leaning back, taking a little bit of a pause. I would just encourage everybody, and I could probably spend the entire hour talking about why people should continue, especially our high net worth clients, doing this type of planning. I believe that spousal lifetime access trust will remain extremely popular. And just as a brief overview about what that is, and most of you probably already know, but it's a mechanism when you're dealing with families moving this kind of wealth $26 million in total of value, which many times is depressed due to valuation discounts. They go, we're going to make the next generation extremely wealthy to our peril. So what they do is they tie to the trust that's receiving the transfer of the assets, they tie the spouse in there as a discretionary beneficiary. So effectively, they still maintain some type of control. And I just can't emphasize this enough. Delaying this planning, look, in 2 years, there's going to be potential changes with the House and the Senate again. And in 4 years, we're going to have another election. So, there were a lot of proposals. If the Democrats had swept, I can assure you the exemption would not have dropped to 7.8%, 8 million. It would have probably been somewhere around a 3 to 5. But their change is inevitable. And I think we've always seen with tax policy, it ebbs and flows. We're probably going to get something next year, but that's another discussion about what the Trump administration will do. But continuing now with asset values, we can move assets out of someone's estate, allow them to maintain some form of control over that asset or access to that asset. And if it doubles, triples in value, it remains out of their estate. And if any of you have been on calls with me with clients, they've heard me say this over and over again. Even if the estate tax were repealed, I can make many arguments of why moving assets away and doing this type of planning is very important, especially for asset protection and generation protection. So if we don't act, we're losing an opportunity. I'm not going to go through all of these. These are some variety of things that our clients do at the end of the year when they're talking about making the annual gift to family members, to charities, and to other arrangements. I would just point out a couple here that are really important. We have a lot of closely held high net worth PCS level clients that have closely held entities, and we can get extremely aggressive with valuation discounts. And I don't mean pushing Gus's team to give us a 60% discount, but you're talking about an asset that can get some discounts that can really enhance the benefit of the gift. The other thing I'd point out that gets overlooked a lot, but we have a lot of clients that do this, funding 529 plans. You can do up to 5 years of the 18 times 5. And in a lot of times, grandparents will do that for grandkids, and it's a very effective way of moving large sums of dollars into 529 plans. The other item I would just mention is charitable trust. We do a ton of those in the firm, and depending on where the AFR is, generally if AFRs are high, the AFR rate high is a high number. Charitable remainder trust tend to be more beneficial from a deduction standpoint. Charitable lead trust, if the interest rates are lower, tend to be a lot more favorable for a charitable deduction in that case. And we can run scenarios literally in a matter of minutes if clients have scenarios they'd like us to run between now and the end of the year.
And Mike, those trusts, just to interrupt you, that AFR is the applicable federal rate, which is the minimum amount of interest rate that needs to be considered for valuing a related party type transaction. But these trusts, the remainder trust means the charity gets the donation at the end of the life of the trust. And on the lead trust, it's getting a donation earlier in that process, earlier in the life of the trust. Is that right?
That is correct. And the AFR, if you think about it, it's the computed rate that the asset that's gifted into the charitable trust is deemed to earn over the term or the life of the trust. So it's really not a factual thing. It's just what the Treasury puts out every month and says, this is what you're required. If you set up a charitable remainder trust in November, you must use this rate. And that rate is deemed to earn. So earn that. The asset is deemed to earn that. So if the rate's high in a charitable remainder trust, it means that there's more money deemed to be earned over the time of the trust, which means the back end, after the term expires, the charity is considered to be receiving a lot because the deduction is now not at the end of a 10-year term or whenever the trust ends. Next. So this is the last slide, and I'll make this point because the EGT team gets heavily involved with this in January and February. But as I mentioned, that when you have a trust or an estate income tax that has net or taxable income higher than or at 15,200 or more, it's being taxed at the top rate, 37%. So many times during the calculations after 12/31, we go, oh my gosh, we didn't make any distributions out. We're going to pay at the top rate, and the beneficiaries are taxed maybe at a 15% rate or a 20% rate. And if we'd paid the income out as a distribution, the trust would not be burdened with a high tax rate, and we could move that to potentially a next generation or whoever the beneficiaries are in a lower tax bracket. So the out is a 663B election. We do a lot of these, and essentially you can make within 65 days of the end of the year a distribution, and it's deemed to have come out in the previous year. And it's not 100%. It can be, we are only going to do a distribution of 80% of the income. So you can sort of determine what you need to do. But the only reason I mentioned this is that if we get past the end of the year, because many times when going into December, a trust really doesn't know what its income might look like. So we do have this 65 days post 12/31 that we can look at to see if we need to make some form of a 65-day election. And we do quite a bit of those. And that election sometimes can eliminate or at least minimize the net investment income tax.
So it then becomes on the individual, the beneficiary, to pick up that income, and might affect planning for them as well and what they would owe for taxes for 2024, which they wouldn't know until this planning takes place after year end.
That is correct.
All right. Thank you, Mike. I think we now switch back to Marcy to talk about some other considerations besides just income tax that come into play here.
Sure. So don't forget, whenever your income moves, not just the regular income tax might change, but you might also face other kinds of taxes or going up and down. So net investment income tax, alternative minimum tax, and self-employment tax. Obviously, self-employment tax affects those people who either have a pass-through entity that pays them self-employment earnings, or anyone that has a Schedule C, so a sole proprietorship, and that can be director's fees. It can also be a business that you have. If your business is up or down this year compared to last, then you need to take into consideration the self-employment tax effect of that as well. For net investment income tax, anything that is passive in nature or investment income is going to be subject to net investment income tax. There is still a gap between non-passive, non-self-employment income that's not subject to either one of them. And there can be some opportunity there if you sell a business that's non-passive to exclude the gain from the sale of that business from net investment income tax. So we definitely will discuss that if you're selling your business. And then with the AMT, I wanted to go back to that. In 2025, if the changes to AMT do sunset, then AMT is going to start affecting many more taxpayers than it is and has been since 2018. So all of the sort of pre-2018 exclusions and limits will come back into play, and there's a drastic difference in them. And so if you were subject to AMT regularly before 2018 and haven't been since then, if they don't extend TCJA to accommodate for that additional exemption amount, then it's going to come back. It's time to think also about things like whether you want to elect into pass-through entity tax for additional states if you haven't done that already. Also think about what was your residency in 2024 and what might it be in 2025. So if you are in the process of moving, or if you're sort of merging from your primary residence to your secondary residence, which you're then going to call home, you definitely want to talk to your tax advisor about what your move date was and what what makes sense from sort of a legal perspective as to when you changed your domicile. Sometimes that can be a very gray area, and we definitely want to talk about it and make sure that you're making the right decision as to when your actual move date was. State tax credits are available in a lot of, especially the southeastern states, so you can save, basically lower your state tax rate by buying state tax credits. So if that's something that you normally do or haven't done in the past, I know we have a lot of taxpayers in Georgia who take advantage of that. You definitely want to start thinking about that now. Anything else, Sarah?
I think that's it. We'll go to our last polling question here. So yeah, so have you started year-end planning conversations with your tax advisor? Yes, this is a self-serving question, but we like to ask it anyway. Want to know if you have started those conversations, would like to talk to someone, have already got a meeting scheduled to talk about what you can do and how your income position or deduction positions might have changed this year. Our team is having a lot of conversations, and but there's always room for more. So we'll give you a moment to answer these questions. But while we do that, I also want to say thank you very much for attending today. A reminder that there will be a recording of this webinar made available in about a week, maybe hopefully less. We'll be out before Thanksgiving. And we really appreciate your attendance today. And if you have any questions, please reach out to one of the speakers today. They'd be glad to hear from you. So I think that's it. Maddie, we've got all those questions in there, and we are good to go. So thank you all. Have a good day.